Thank you very much, Tom. It's a pleasure for me to present the numbers for Bilfinger for the first time. I started off December the 1st. I don't think it's the best time for a CFO to start off. You come in and you feel that you would like to change one or another thing, but you can't really change much going into the past year. And I was focusing on the cash side because that was where we saw at the end of November here we need to strengthen whatever we can in December to improve it. And I will come back to the good and the bad sides of me also pushing the cash in December. But let us start off on the order book side. I think here we exceeded the expectations. And as Tom was saying, we closed 2018 having a 10% increase versus last year, organically even above 12%, so 12.5%, extremely good and also motivating now going into 2019, having a very solid base load for 2019 and a lot of the work that we need for 19 already in our books. Especially worth mentioning that we had a strong order intake from both sides, from both our segments, but especially on the E&T side coming in. Book to bill, we closed the year 2018 with 1.1, and our order backlog at the end of 2018 was 11%, 12% organic. So very, very good start of the new year 2019 then. If we look at the revenue side, we also here managed to achieve the expectation of the 5% increase in revenue year by year. We even organically closed at 5.7%, so very strong performance. On the EBITDA side, we closed the adjusted EBITDA at 65 million, 1.6% margin, which was a good step forward. And as mentioned by Tom, the last quarter, which belongs to the strongest ones year by year, as we have some seasonality, was also a very good performance with 3.3% profitability adjusted EBITDA, slightly below what we had in the quarter, the same quarter 2017. However, in 2017 we had some projects that were closed and generated, I wouldn't say a special profit, but an upside in the very end of these projects. Looking then at the reported EBITDA, we are closing at -7, so we have 72 million special items or adjustments included here. That is to compare with previous year where we had 121 million as adjustments, so we are going in the right direction here clearly. Most of these items are continue to be related to the sale of some of our legal entities. The effect of that, we are showing it here, 17 million. The rest related to compliance, to IT system that we are rolling out over the last years, and also restructuring cost. And obviously it's a clear target here to reduce this amount year by year, to get closer between the adjusted and the reported EBITDA. So a big step forward here, and if we then continue to look into the two main areas on the cost side, we are looking into the gross profit, where we in our 2020 strategy have said that we would like to improve our gross profit with 2%. We managed to close with a margin level in 2018 of 9.4%. Previous year we had 8.4%, so 1% improvement, which is good, but we also have to be honest and say that this is an area where we will need to get more out of this going forward in the next 2 years, and that's a lot of the focus for our COO, Duncan Hall, to make sure that we are getting more out of the existing contracts and projects that we have. So here we haven't made the progress that we would like to, but there is more to come, and I think there are a lot of activities in many of our entities to improve this. This is obviously a combination of executing what we have in the order books in a better and more solid way, looking for more profit on these contracts, but also to pick the development areas that are more attractive, those that are generating growth, but also those that are generating a stronger margin than the average here. And we will hear more about that from Tom in a minute. So it's a combination of this, and obviously also, as we have a strong order intake, to in some cases also train our people to get a bit more picky when they are taking up new contracts, to be more selective. So it's nice to be in the position that you can allow yourself to do that. Then looking into the next area, beside the gross profit, we are also looking at the SG&A, where we have said in our strategy that we want to get 3% EBITDA improvement out of this. And looking what we managed to perform in 2018 from an absolute number, we are at the same level. However, we need to keep in mind that we had a growth, so we didn't increase our SG&A with anything due to the growth. And we also had, if we compare year by year, in 2018, 20 million included for further business development and Digital Next. So we managed to do more out of this money. But this is an area that I will focus on a lot going forward, because I definitely see that there is potential to get more out of this. And if I remember from the strategy that was presented in 2017, we would like to get down to the level of 7.5%, so there is at least another % to get out of this. Good. Then looking into the two areas. Starting with E&T, which made a good progress last year in regard of getting order intake up, increasing the order books. So we are talking about an organic increase in orders received of 34%, and we are talking about 33% organically in the order backlog. Also on the revenue side, last year we had an organic growth of 8%, significant contribution from North America. And also in regard of the margin, we were then ending up at a level of 2.2% in the adjusted EBITDA here. A very, I think, a good step forward, and we will also compare this obviously when we are coming to the point later on the new changes to our organizational structure. Then looking into the larger segment, which would be the MMO, here we had an increase in the order books of organically of 9%, order backlog with 6%, and the revenue also with 6%. EBITDA adjusted margin, we closed at 4%, and we had especially here a very strong performance coming from the region Northwest that Duncan Hall just then left at the end of 2018. So a very strong performance, and especially in the last quarter, this division performed extremely well. Last but not least, to make the calculation work, we also have the area OOP. Here a lot is legacy. The legacy is getting less and less, which means that 13 legal entities have now been disposed or terminated until the end of 2018. We have 4 left that we hopefully will be able also to close in 2019. 2 of them have already been solved in the sense that one is signed and one is closed. So we are quite hopeful that this work will be finalized until the end of 2019. We also have then the performance of these entities here, and here you see obviously that getting less and less entity into this division, you see that we are moving down on the profitability, but also on the revenue line and order books. The profitability was a little bit burdened here this year and not improving because we have 1 legal entity that belongs to the remaining 4 this year, which has not performed very well, and that is South Africa. But that's a structural problem in the utility business in South Africa, and it will be solved, we hope, until the end of 2019, as we are trying to sell off this entity. Then going into cash and the cash generation, we have also here a strong performance, a lot related to the last quarter. So the voice was heard in December. We need to get more cash. Some did it in the right way, worked a lot in December also on reducing the work in progress and the DSO. Some of our divisions, however, also took a part of that improvement by using the suppliers a bit more than they had before. So we have an improvement if we look at Q3 versus Q4 on the DSO side. But if we look at comparing 17 to 2018, we are more or less at a similar level. And we are, of course, here in the DSO, including also the prepayments and also the VIP. So it's not only the accounts receivable. This is also something that I'm sure that we can further improve our developments on the DSO and get more cash out of the working capital. But as we are showing also on this slide, you see the development of the accounts payables, and also here in December we had more accounts payable hold back at the end of December. So it's a combination. If we look at the development of the cash flow, you see it on the left hand, on the corner, you see the improvement, the adjusted operational cash flow moving up to 110 compared to previous year with -7, which is a step in the right direction, but also here more to come and more to get. On the cash side, extremely important, improving this further quarter by quarter as we proceed in 2019. And if we look at the reported and the adjusted net profit, we see the reported numbers -24, previous year -89, adjusted net profit moving up to 36 versus -9 last year. And the free cash flow almost reached break even. We ended up at -4. Last but not least, looking into activities that will bring us further improvement. Nothing new here, it's ongoing, and we have benefited from these activities already, but there is also more to come. So we have the IT projects. Most important part here is the harmonized, standardized ERP system that we started to roll out in 2017. We have by now, by the end of 2018, a degree of completion of around 40%, targeting to get to 70% by the end of this year. Extremely important to also reduce our cost, but also to improve the transparency. We have seen in those entities that have the implementation that, for example, transparency on the working capital has improved a lot and helped us also to, in reality, get the cash in earlier or get more cash in. Then looking on the procurement side, continuous improvement here. We see increasing number of e-auctions. We are also trying to bundle the procurement more and more. Bigger is better in the sense of better pricing, and we will continue to drive this a lot on the operational side. In some cases, we are obviously also buying for our clients. This is an area where we also, with the increasing activity, need to get more margin out. Merger of operating units. Since 2016, there has been a strong drive to reduce the number of legal entity, to reduce complexity in the Bilfinger group, but also to, of course, make savings and getting less units with a more clear and larger size, all to make sure that we have a good offering to our clients, but also on the HR side to make sure that we are able to be attractive for managers that would like to join us. Having a clearer, a bigger size, it will make it easier for them to also drive the business. And as you can see on the right-hand side at the bottom, we started off in March 2016 with 279 legal entities. We were at the end of 2018 down to 168, but the drive down will continue. One very good example that just went live is Austria, where 5 legal entities at the beginning of 2019 were merged into one. which gives us a completely different size in the Austrian market, but also helps us then, of course, to be more efficient in all our processes. So this work will continue, and these activities here and initiatives will continue through 2019, 2020 as fast as possible to also support the development and the turnaround of Bilfinger. Then I would like to pass back to Tom.